What is going on with the stock market and the economy right now? I wanted to do a video here to go over a bunch of things, go over kind of the crazy markets that we've had recently, and go over some charts and over what I think might be going on. So let's share the screen here. What I'm going to do is I'm going to go over everything kind of piece by piece, and we're going to focus in on the chart to look back on what has happened. Okay. Just one reminder as well, I do have a podcast coming out next week. If you go to my website, investlikemike.com, click podcast, and you'll see my most recent one with Mark Loeffler here. And I'll be having Benj Gallender. I just did a podcast with him last week, and we're going to go over his thoughts on what's going on in the world right now. Okay, so this is Benj Gallender over here, and we're going to be talking to him. You can listen to it through audio format here as well, and you'll see the video posted at the top here next week. So let's dive into the charts here. What's going on with the markets? Let's zoom out right away here. So I'm actually zooming out here a lot. This is a weekly chart. And what I'm doing here on purpose is I'm zooming out just to show a couple of specific periods that we have here on the chart. And what I'm looking at here is when did we have excessive bubbles, so to speak. So here we have the internet bubble, and you'll see that I have a red line at the beginning of it and a red line at the end of it. So this is around 1995, and I remember around 1995 in Canada here, everyone kind of started to get one or two computers in their house around that time. 95, 96, 97, 98 was really hot for computers and the internet. And so when I'm looking at that, there was a really excessive move into all kinds of random websites like the pets.com that people always talk about, amazon.com, but also just the sale of computers with Intel, Microsoft, and other companies that benefited. Even AMD was making moves back then. And although there was a lot of productivity, it was also a bubble, and you could see the angle of it and the normal angle and trajectory back here. It was much sharper and much quicker in terms of how much it went up. After a big period like that, where you had a healthy economy that kind of became a bubble, you'll often have kind of a choppy figuring out period, which is kind of what we had from about 2000 until after the 2008 crash. And then we jumped up out of there in a more aggressive fashion again, just like we did back here, starting the same cycle all over again. And eventually we had to have another recession, just like 2000. That's the way I'm viewing this, is that you kind of have this figuring out period / rally period, excessive rally, and then the hangover, the correction, the recession. And sometimes if the bubble gets big enough, it takes a little while to get figured out, and then the next one commences. Right at the end here, we had this COVID jump that went straight up like a telephone pole right at the end. So let's zoom in here, and you'll see that we had this big move up here. It was really sharp in comparison to the general trend here. Well, that kind of reminds me of the 80s and the early 90s compared to the mid and late 90s, which was the excessive move, and we called it the internet bubble years later. Well, what if we call this the pandemic bubble, and there's a correction right now that will eventually go higher later? That's kind of what we're looking at, and we can't guarantee how low it will go. But one thing I like to use is I like to use the chart as much as I can. There are Elliott wave patterns in place. That's something I go through in my training course and my weekly training sessions. And, I'm going to go over a couple of things here. So Elliott wave patterns, when they're moving to the upside, they'll often go, let me go switch colors here, folks, go red. So they'll go often in 5 waves to the upside, okay? And you'll see that there. And then, even after a nice bull market like we had in up to the year 2000, then maybe you have a big, ABC type correction, so to speak, to the downside. And that is probably what we're doing right now, I think. And I believe that what we've just done is that we've done a correction. We're trying to bounce, but we might actually fall lower still. And I'm going to show you why that might be the case. And let's go back to the chart here. Okay, so, sometimes they're a little hard to see, and the more practice you have with it, so to speak, maybe the better you get at it. They're a little bit subjective as well, but kind of what I'm seeing here potentially is you have an initial jump up here after the crash of 2008, and I believe that you would have a dip here with a really long, manipulated, complicated wave 3. You have the COVID wave 4, and now we have wave 5, the last jump up at the end here. Now we're going into probably an ABC type correction. And if you look back here in 2008, it was kind of an A, the B was kind of choppy, and then the C. Okay? So, there was probably a 5 wave here, a 3 wave here, a 5 wave here, and now maybe we're going to get another 3 wave to the downside. That's pretty much what I'm thinking here. Now, how did that work in past recessions that we could compare to the current one? I don't know that we can compare this little move here, the 2003 to 2008 move. I don't know that we can compare that to this gigantic beast over here. So when I'm looking at it, if you zoom out a little bit more, okay, what you'll see is, and you can barely see it on the chart, but we had some stagflation or choppiness here in the 70s. There was a figuring out period. Look at the choppiness over here in the early 2000s, right? Well, we had a big post-war inflation back here, followed by stagflation. Then we had interest rates falling and inflation all the way through the internet bubble over here, stagflation, some sideways kind of movement here. Now we have a ridiculous amount of inflation again. I feel like we can go sideways for a while here. I mean, how are they going to hike rates enough to solve inflation? That's not good. That would probably require too high of an interest rate for us to tolerate. And how can they stop lowering rates or printing money eventually to keep the economy stimulated? They kind of have to do something. You can't just raise rates and do nothing and wait for people to get in trouble and not allow for a robust economy and keep your GDP low and all of that good stuff. It's going to be a weird period coming soon. And I think if we look at examples of the post 2000 figuring out period, it was just trapped in this corridor sideways, and it went up later, fueled by money printing and cheap interest rates. Let's go drag this chart back. Okay, so let's go look at the 70s here. Now, notice how it didn't look like anything before, but what you have here is that we rallied all the way through the war and the post-war time here. We rallied and we rallied. And if you talk to people who were around as adults in the 70s, there was a lot of cheap interest rates and people leveraging and taking on a lot of the debt. And we reached peak inflation around 1982-83 range. Look at the choppiness here after a huge, long, extended bull rally, and you have kind of a holding range sideways before the next eventual move up in the 80s and the 90s. I think we're going here. I could be wrong. I think we're kind of finishing out one of these or one of these, and we might be going into a stagflation like the 70s. That's what Ray Dalio is predicting, and maybe that's not exactly what happens, but I'm showing you some examples of how that's happened in the past, where there was whether you want to call it stagflation or here's the early 2000s, there's a figuring out period. Okay, I mean, again, I want to point out, look over here, this is the regular cycle, the regular movement of the market. Look how sharp it was with the internet. Look how sharp this one was with the housing bubble. That was pretty sharp too. This whole recent move, the whole thing, this is even before COVID. It's still pretty darn sharp if you look at it. Technically, it was pretty sharp already. But watch when I drag it over, right? The COVID rally was even sharper than all of them, right? This was, trillions of dollars and a huge pandemic and all of this stuff all rolled into one with cheap rates. So the US had like zero rates for a long, long time. So what happened after the internet bubble? How much did it correct? So let's go zoom in here. Let's use the charts to our advantage. So we did a Fibonacci retracement from here to here, and it landed in and around the 61.8% Fibonacci retracement level. Okay. Now, again, if you do your training with me on the weekly training sessions on Sunday, you can check out my website if you are interested in that. If you go here under the store page here, you click on weekly training sessions and you can sign up there if you would like. So when we're going through this here, we're looking at, that's what we expect. That's what I teach people to expect if you're going through a really decent correction of meaning for a specific purpose, like the year 2000 or a pandemic or a war or something like that. So when we're looking at it from that perspective, could that happen? And I want to point out to you as well, this correction, it was 61.8% of that move up, not the history of the whole stock market, just of this internet bubble, which kind of started around the mid 90s onwards, kind of fueled up big time for about 4 or 5 years, and then rolled over after that hot 4 or 5 years. Okay, so that's a normal, healthy thing after an excessive move like that. So when you look at it now, we had this big, huge move over here, fueled by money printing, and the pandemic was the catalyst. If you look at it, there's the move, right? So could we correct to my landing zone here of the 61.8% Fibonacci correction? With all of these interest rate hikes going up, that wasn't happening all over here. When were they doing all kinds of interest rate hikes? They were doing low interest rates before, even before the pandemic. The interest rates went up a little bit in 2017 here in Canada, and they brought them right back down. So at the end of the day, that's the way I'm kind of looking at this, and I'm saying, wow, look at the reaction when the rates go up. People don't really like that. If you look at it, it's almost the same size as the original. Let me take these off the screen here. It's almost the same size as the original COVID drop over here. If you look at it, we're getting in and around that magnitude a little bit further, and will be about the same magnitude as the COVID drop over here. So, right now, this is a weekly chart. The COVID drop brought us below the 200-week moving average. The 2018 trade war brought us to the 200-week moving average, right? So in case number one with the trade war, not super, super, super severe and compared to the pandemic. And in a more super severe situation, we went well below the 200-week moving average. So where are we going here? Where are we going? Are we going to 3,600? Are we going to 3,200? That's kind of what I'm looking at here. I don't think we're done. We hit about 3,800 or so here. I think we're going to go into at least the mid 3,000s, if not the low 3,000s, and probably find a bottom here and try to figure something out later. I don't know what the in-between is going to look like. I don't know if we are going to get some kind of a bounce up here and go down later and then rally from there. But I think we are in a weird figuring out period. Notice how when the COVID drop happened, let me zoom in here. So here's the COVID drop. Okay, this is the weekly chart. Now, why did it go so sharply up like this? Why did it do that? Well, it wasn't just magic, folks. It's because they printed that much money. They printed $2 trillion to cause that rally. We would not have broken the old all-time high like that without the money printing. And so, we didn't even have a vaccine yet. That was pure money printing, like a life preserver. They're not doing that. They're doing the opposite. They're saying we will not print money. We're already in trouble because we printed so much darn money. We're actually going to do the opposite of money printing, right? We're buying back bonds. We're doing the tapering process. We're raising interest rates aggressively, and we're going to keep raising rates for the rest of the year, whatever we have to do. That's the way they're talking, so I'm going to listen to them. When they said we're going to print money, I listened, and I bet up. They're saying we're going to undo the money printing and raise rates all year. I'm listening. I went cash, heavy cash, earlier this year. And I went heavy stocks, not cash, here, right? So I listened, and I went stocks when I was supposed to, and then I went cash when I was supposed to, so to speak. And if you listen to Benj Gallander's interview when I post it next week, we talk about that. And he's about a third cash right now. So if you look at it from this perspective, and we're looking at these Elliott wave style moves, I think we're seeing this. Okay, we just did a 5-wave pattern, a completed 5-wave Elliott wave pattern there. And you might say to yourself, Mike, is this not the ABC correction? Well, I mean, it could end up being that way, so to speak. That's probably the way it kind of went over here. I just don't think that's going to be the case. I think what's going to happen is you get 3-wave corrections during a bull market. Okay, so the dips are often 3 waves during a bull market. So why did that happen during COVID? Let's zoom out. Were we in a bull market or a bear market leading up to COVID? We were in a huge nonstop bull market. COVID happened. They printed this much money to make it as if we're still in a bull market as a life preserver, and then we continued higher. That's why we only had 3 waves here to the downside. Right now, I think we're going to have 5 waves to the downside. I think this bull market move right here, this market cycle, They typically last between about 8 and 12 years. March 2009 till now is in and around 12, 13 years. We're right there. Okay, so 1, 2, a really big 3, complicated 1, 4, 5. I think that's what we're doing. And now that this is done, we've done a full long-term 5-wave to the upside like that. Well, now I think we have to do a 5-wave to the downside. I think that's what we're in for potentially here. So right now, will we do something like this? 3, 4, 5, and then land somewhere in here. Okay, I think that's probably still what's coming. Notice the way I drew it. The timeline brings us towards maybe the end of the year, so to speak, the last half of the year. If they keep raising rates more than we thought they would, and other things happen in the world, then maybe we come either to or below that 200-week moving average, which would line up with the 61.8% Fibonacci correction level, just like the year 2000 when we corrected. That could happen, right? But even 3,600 would be, you know, a lower low than right now. There's still a drop that would need to happen there. So, you know, this is the way I'm looking at it. This is the way I use the charts. And, you know, I try to use other forms of analyses as well. And one thing I always tell people is, you know, every battle is won before it is ever fought. If you know what to do, if you knew that, you know, money printing at a time like this, along with others along the way, would lead us higher and cause inflation, and then you knew when they canceled the money printing and did the opposite of money printing, that it would bring us lower. That's the way I've been looking at this. I've been using the charts, strategy, and the fundamentals of economic cycles all kind of together. Let's go look at the interest rates chart here, and then I'll let you go. What I want to point out here is, you know, we can complain that they're raising rates, but, you know, talk to your grandparents or your uncle or anyone that was around, you know, before I was getting a mortgage and before a lot of people listening might have been dealing with interest rates. Look over here. Okay, we look at Russia and other countries that have 20 or 18% interest rates. This was Canada. This was the USA. This was the world around 1980. Okay, so you'll remember I pointed out how in the 50s and the 60s we had a huge bull market. In the 70s we had kind of stagflation. Well, look at the choppiness of the interest rates in the 70s, up, down, right? That's kind of what we're probably going into right now. So if you look here, they tried to raise interest rates a lot after a bunch of inflation. People couldn't tolerate that for very long, so they came down. Then they said, uh-oh, we have to raise rates again. We still have inflation. Back up even higher. People couldn't tolerate that. It came back down. Then they said, oh boy, we still have inflation. And we hit record inflation in the early 80s. Okay, so I wanted to talk you through that so you can understand. Look at in a rising rate environment, look at the swings that we had, right? Well, now we've switched to the opposite style where we rely on lower and lower and lower rates and higher and higher and higher debt loads. And through the use of internet and computers and financial education, people leverage and invest more than they did back here in the post-war era. That was for really rich people probably, and you had to have a broker, and it was way different. You looked at your newspaper for a stock quote. It was very different. You know, if you look at the interest rates here, ever since the peak, what has happened is any period such as right here where it went up, it only made a lower high. So we have this high here. Now we make a lower high and we drop again, right? Then we went too cheap for too long. Let's raise it up, right? That 1987, 1989 period, we had the markets turning over. Now we raised them up, right? Okay, we made another lower high again. Look, 1, 2, 3 is lower than 2, right? Then it goes down. It made another lower high for number 4 is lower than number 3. And now over here, we even made number 5 lower than number 4. Look at the little interest rate hike going on right now, guys. Look at this. That's where we are so far, okay? Now, are we going to go higher than number 5? Maybe. Are we going to go higher than number 4? I doubt that. I just think we've relied on declining interest rates for so long that you would cripple and kill your economy if it went up like this to 8 or 10%, that would crush the economy, right? People don't pay cash for their homes and their cars. You have financing, and the reason why you do is because you know the rates have been low for a long time. So I don't think politicians will choose to do that. I think what will happen instead is maybe something like this. See here? Jump to 4, drop down. Jump to 4.5, drop down. Jump to 6, drop down. They would have to really ease their way into it over the course of maybe 10 or 15 years. They can't just go up all of a sudden. So the same way that this is chopping its way to the downside, if we start moving higher, I think it's going to have to chop its way higher. And that could lead us to some kind of a stagflation, or, you know, push the gas pedal, hit the brakes, push the gas pedal, hit the brakes. And that's kind of why I've been pointing out, you know, this is what happened after the 90s bubble, right? We had this big drop, big rally, big drop, big rally. And we had this figuring out period after a bubble over here. Maybe that's what we're doing right now. And let's go check out what they did around the year 2000. What did they do with the interest rates? I'm not sure if anyone's ever looked at that specifically, but I was checking it out today. Let's go back to this chart here. What did they do around the year 2000 over here? So you'll see here that interest rates were dropping aggressively leading into that kind of crash of 2000, and then they had to raise the rates after that over here. So, you know, they did end up raising rates during or just after that 2000 crash, and that seems to be kind of what we're doing again now. Even over here, the 1980 crash, 80-81 crash, they were raising rates leading into it, and then the rates went even higher. So it should be expected that we have rates going up right now. That's the way I'm looking at it, just like after 2000, just like after a lot of big bullish movements in the market. So right now, I think all we're looking at is how low will we go? And right now, it's looking like we're going to do some kind of a dip to or below that 200-week moving average. We haven't even touched it yet. I think that any bounce right now could probably get sold a little lower still, especially if they keep raising rates. They're going to do 0.5% apparently on June 15th, and I think they're going to raise again after that again, and you're going to see the US interest rates over here probably climb higher, like I said, over here towards this top. This is around 3-4% range here, and I think that's probably at least where we're going to head to here. I don't think we're going to go above this range, but we will see. We will see. I think we'll be in a recession by then, and they'll maybe have to lower them again and raise them later. That's probably the type of thing we're into. And again, if you want to see examples of it, right, in the 70s, we had stagflation. They brought it down, higher, brought it down, higher. They did it slowly over time. So that's what I'm looking at. That's how I'm kind of treating it. Hopefully you enjoyed that. This is the type of analysis I go over every Sunday in the weekly training sessions. Remember to check out the podcast with Benj Gallender. That's his book here, Contrarian Investors 13. And we're going to go over a bunch of great stuff. Make sure you do check it out, guys. Go over to the website, investlikemike.com, and make sure you click on the podcast link at the top, and it'll be posted fresh right at the top of the page next week. You can click on Spotify if you want to listen to it, or click right here if you want to watch it on YouTube. Thanks for joining me on this one, and we'll see you on the next one. Take care.